So welcome everyone. My name is Mark Freeman. I'm the CEO and Managing Director of the 4 listed investment companies that we'll be talking about this morning. But before we start, I'd like to begin by acknowledging the traditional custodians of the land on which we meet today and pay my respects to elders past, present and emerging. The format of this morning's meeting is different from what we have done traditionally in that we have combined all 4 of the LICs into one presentation. We believe it is not only more efficient, but hopefully more interesting that we can talk about all the portfolios and our approach to investing across the market, as well as providing a broader view of what is happening in markets here and globally. And obviously, shareholders will have the opportunity to ask questions across all the team members at the end of the presentation. We have used this format before and the feedback has been very positive, but any thoughts you have about this meeting would also be appreciated. So before we start the presentation, I'll introduce the people sitting in front of you. We have David Grace, who's the portfolio manager for AFIC. Perhaps put up your hand as well. Olga Kostrachik, who's the assistant portfolio manager for Djerriwarrh Investments. Kieran Kennedy, who's the portfolio manager for Mirrabooka. And I'm the portfolio manager for AMCIL, so I'll be talking through that one. And also Jeff Driver, who is with us, who's our General Manager of Business Development, who will facilitate the questions and answers. And in the front row, we have our CFO, Andrew Porter, and other members of staff and the investment team. They've all got name tags on, and they will all be available for questions at the end. Also, at the end, feel free to approach us over a light lunch. And with that, we'll get into the presentation. Just our disclaimer to say we're here to talk about the companies. We're not here to give any advice as such. An overview, I'll give that. And then, as I mentioned, then each of the people on the stage will talk through the various portfolios. I'll make some closing remarks and then we'll open up to questions. So just a bit of background on the 4 LICs. So all 4 of these are listed on the stock market. You can go in and buy shares. But each of the 4 has a different approach to investing, and that tends to suit individuals' needs in terms of what they're looking for in terms of returns out of the market. So if we start with the Australian Foundation Investment Company, which is our largest fund, it's close to $10 billion. It's been around for over 90 years. The MER, which is essentially a cost recovery because there's no fees that are charged on our LICs. There's no external fund manager. We are simply a cost to the 4 LICs. So that comes out at 0.15% with no performance fees. So pretty much all the value that's created in the portfolio goes to you, the shareholders. It's a broad-based portfolio that covers most of the market. Grossed up dividend yield at the current share price is around 5.3%. So that's the yield when you include the franking credits as well. We look to have a broad exposure to the stocks. We want stability of dividend and income over the time. We like lower volatility returns than the market if we can. And we want to be in good quality companies taking that long-term view. And we want to keep turnover low because we understand that the more you turn over, the more tax you'll pay, and tax is a drag on total returns. Djerriwarrh Investments, which Olga will talk through, we're a bit more focused on income, and the trade-off between higher income can tend to mean you might give up a little bit of capital. There's always a trade-off in markets, but as you can see, it produces a very attractive grossed-up dividend of 7.3%. But as I said, we do give away a bit of capital. So those that are seeking income, so it's probably no surprise that a lot of our investors are in self-managed super fund, particularly there's a lot at the pension stage where you can get full value for the franking credits, the substantial franking credits that we pay out. Mirrabooka focuses on mid to small cap stocks. So theoretically, I guess you're taking a little bit more risk, and then, as Mirrabooka has shown, produce very good returns over the long run if you manage it well. You can see the MER there, 0.56%. But still produces a very strong dividend yield as well at 6%. So you can get exposure to mid-small companies, yet still receive a very attractive dividend flow along the way. And then AMCIL, we call as our high conviction fund. We're trying to have a spread of large, medium and small cap stocks. The aim there is to be really focused on what we think are the best quality companies in the market, taking a long-term view. We're not trying to be an active trader. And you can see the MER 0.56%, and you're still getting a reasonable yield of 5.3%. when you include franking. So the team, we've got an investment team that focuses on certain particular stocks, but they sit across all 4 of the funds. So the team all sits together. We run this as a team. Our incentives are all based on the performance of all 4 of the funds together. And so we're all in it together in one team, and we're all significant shareholders as well. And so there's a real alignment there with you, the shareholders, in what we do. So as I said, just some other features. I mentioned that we're internally managed, so there's no external fund manager that fees are going to. We want to be a long-term investor. We want to get the compounding effect of great companies. We're aware that tax can be a drain on performance. We do note that if you're in a managed fund or even an ETF, they'll give you the performance pre-tax, and then you've got to go pay the tax yourself. We wear that. And so when we come to our performance numbers, you have to be aware that we're post-tax, particularly this last year that we've been in. We've done a fair bit of activity, which has created some tax. That impacts our performance numbers until we pay out the franking. And so therefore our performance numbers that you will see is a pretty conservative way of looking at it, because all the funds now have substantial franking credits that at some point we can pay out to shareholders. But in the short term, it does impact our performance because we are showing the impact of tax on the numbers. As I said, our incentives are for performance, not just growing the funds. We're sensitive to income. We understand shareholders like dividends, franked dividends. We understand that our profit reserves, which can come from capital gains, can also be a source of dividends over the long term. And our profit reserves can also provide us some stability in terms of producing dividends in the tough times. Our LICs, being independent companies, all have boards of directors, and that's, I guess, part of the privilege of working on these is being able to attend meetings, and the experience that our directors bring to our funds is incredible, and it's a very important aspect of our role is having the directors involved with the funds. So with that, what we'll do is we'll give an overview of each of the 4 LICs, then I'll come back and then importantly open up for questions. One of the most anticipated questions, which I know we're going to get, is about Trump. And I thought, do I address that now up front and give some thoughts? But I thought, no, I won't, because if I do, by the end of the presentation, he may have changed his mind. And so whatever I've said may be completely irrelevant. So let's save that till the end and we'll get panel's views, but I'm sure we're very happy to answer the questions on that as we go. So we'll start with David Grace and talk about AFIC.
Thanks very much, Mark, and good morning, everybody. So just a reminder, in AFIC, we're long-term investors in quality companies. So we're looking for a minimum 5 to 10 year time horizon. We're not trying to pick short-term trends in markets or the next move in the economic cycle or interest rates. So we want to own quality companies over the long term and really benefit from the power that compounding returns deliver to shareholders holding investments over that time horizon. So just briefly on the operating environment, Mark will cover off later on, but it's clearly been a volatile time in markets at the moment. A lot of uncertainty around what the US economic growth is going to be, whether tariffs come on or off, and obviously what the response is going to be in terms of trade wars, whether they're on or off as well. So with that in mind, we know that equity markets hate periods of uncertainty, and we've seen quite a wide dispersion of returns over the last sort of 2 to 3 months in particular. And for a long-term investor, we sort of welcome these opportunities just to add to good quality companies at what we deem to be attractive entry prices. And when you've got high correlation of returns all trending in the same direction, it's a bit harder for us to find opportunities. So we're looking to add to quality companies in this environment. So on the slide, we've got the performance on the left there of the AFIC portfolio shown with the blue bars versus the ASX 200 being the purple bars. So the 1 year return on the left-hand side is 8.3% versus 11.2%. And really being a long-term investor, it's the 5 and the 10 year towards the right-hand side of that chart that we hold ourselves against. And just a reminder that our performance is shown on an after-tax basis. So tax has been a drag of about 70 to 80 basis points per annum over those extended time horizons. On the right-hand side, we've just shown the 12-month performance of the ASX 200 and really split it by sector, just to give you an indication of what's been driving markets. So you can see the ASX 200 is the orange bar in the middle there at 9.9%. Financials have had a particularly strong 12 months, starting to give a little bit of that back, as we'll talk to in a later slide. But the banks in particular drove the majority of that, but also the insurance sector was strong with interest rates holding up longer than what people expected. So both of those we think are unsustainable over the medium to long term. And then if we move towards the bottom of that chart, you can see those sectors that are most exposed to economic growth being the materials, which is where most of the resource companies are, and also the energy sector have lagged. And it gets back to that point around volatility that we've seen in markets and so much uncertainty around what economic growth is going to be. So both of those sectors have lagged the overall performance. So what we've shown here on the slide is first of all, just the two objectives we're trying to achieve in AFIC is to deliver attractive total returns over the medium to long term, but also to pay a stable to growing dividend. And as long-term investors, really quality is the one feature that we believe can sustain over that extended time horizon. And we know most companies that we invest into will go through various stages of business cycles, changes in management and boards, and even changes in strategy. And it's the quality of the underlying assets that we're invested in will ultimately deliver an attractive return over our time horizon. So in endeavouring to achieve that over our time horizon, we really want to own a diversified portfolio of different attributes that are contributing to the portfolio mix. So starting on the left-hand side, we have a mix of growth companies. Now, naturally, it's the largest segment given that equity markets typically move 8% per annum. And in this sector, they're market leadership positions, they're companies that generate significant free cash flow and importantly have the opportunity to invest that back in their businesses to deliver earnings growth over the medium to long term. So this is the likes of Goodman Group, CSL, James Hardie and REA Group. Over on the right-hand side, we have stalwart companies. So these own highly defensive assets. They're not fast growing, but they're still delivering some earnings growth and they provide a useful ballast to the portfolio. Down the bottom right, we've got income stocks. So we recognise that income is a very important part of the total return that shareholders receive. And from income, we typically receive that from the banks, some of the REITs. We've got Region Group and Mirvac, but also the likes of Telstra. And then on the bottom left-hand side, we show our cyclical exposure. And these are companies that are exposed to positive economic growth. Typically, we see economies grow. And in this regard, we're looking for companies that maintain strong balance sheets, they're well managed, and have the ability to generate free cash even at low points in the commodity cycle. So it's typically the majors, it's BHP and Rio Tinto in commodities, and Woodside and Santos in relation to energy. So even though we are low turnover, long-term holders of the equities that we do own, we look to actively manage the portfolio. So looking to capture opportunities where valuation is compelling and equally look to trim some of our holdings where valuation gets to extreme level. And I've shown the example here of Commonwealth Bank. For context, Commonwealth remains material holding in the portfolio, but we have reduced it substantially over the last 6 months. And while we continue to hold it, it's still a very well-managed company, a very strong management team and board. They operate the lowest cost and best retail franchise within the domestic market, and they consistently generate a higher ROE than all of their competitors. What we've shown on the chart at the top is the price to earnings ratio. So this is the multiple of earnings that you've been asked to pay. And at $160 share price, the PE, as we call it, had got to 26 times for Commonwealth Bank. And that compares to almost double the long-term average you can see at 14.5 times. So correspondingly, the dividend yield fell down to 3.4%, and that's below a market dividend yield of around 3.6%. So when we think back to the purpose for why Commonwealth Bank was in the portfolio, it's really for those income attributes. And we felt that it was struggling to justify that purpose, so we looked to reduce that over time and deploy the capital into other better opportunities over our time horizon. So we often talk about being long-term holders, and just wanted to put a couple of slides together, a couple of charts to show what that actually means in practice. So I've shown an example here of ResMed, which has been held in the portfolio for many years. And ResMed manufacture devices to treat sleep apnea. As the photo on the right-hand side, you can see a sleep apnea device on a bedside table. Sleep apnea is a condition where the muscles in the neck will relax during sleep, and will cause a sufferer to choke and literally wake up several times per hour from choking episodes. And that lack of sleep can lead to a lot of comorbidities and a lot of additional disease on top. So it's estimated there's 1 billion people globally that suffer from sleep apnea, and less than 10% of those patients are actually on treatment today. So the business was founded in 1989. It was founded by Peter Farrell, who's the current director of the board. He was the CEO for a period of time and was the chairman subsequent to that. He was working for a company called Baxter, and they decided that they weren't going to pursue sleep as one of their growth initiatives. And so Peter was able to do a management buyout of that business, and starting from 0% market share, he was able to increase that to today's level of 75%. And it's really been that generation of cash flow, investing in the best products in the market, has seen them take such a large percentage of the market up for grabs. So the chart on the left-hand side just shows the consistent earnings performance, and that's represented by the blue bars. It's over 15 years, it's been a pretty steady increase in terms of the earnings you've received from ResMed. The purple line at the top is the share price, and the green line is the ASX 200. So been a material outperformer over the long term in terms of our holding period. And we know that share prices don't go up in a linear fashion, and you can see over the last 2 years, you've had a pullback in the ResMed share prices. There's been a threat from the GLP-1 drugs that have now become more widespread. And the fear being that as people lost weight, there was going to be less incidence of sleep apnea, being a high correlation between the two, and that was going to impact ResMed's earnings. So what you can see is it's been the opposite, that earnings has accelerated as that increased awareness has become more prevalent. And we've seen actually earnings growth expand for ResMed on the basis of that. So we still believe it's an attractive long-term opportunity, and there's still a significant runway of growth for this company. At this point, I'll hand over to Olga.
Good morning, everyone, and thanks, Dave. So on the next 3 slides, I will provide an overview of Djerriwarrh, our high-income strategy. So our key investment objective for this portfolio is to pay our shareholders an enhanced dividend yield. And as you can see on the slide, in the last 12 months, we paid a gross dividend yield of 6.6%, which is much higher than what's available from the broader market, or as we define it, the ASX 200 index, which was 4.4%. The difference between the two is our enhanced dividend yield of 2.2%, which we think is very attractive, especially when we think about the environment we are in. The absolute level of dividends has decreased to the lowest level since the pandemic. What's even more important to us is that we believe that this enhanced dividend yield is sustainable based on our current portfolio settings and based on our option strategy, which really is a unique feature of Djerriwarrh's portfolio. So now looking at our second investment objective is to grow capital over time. And as Mark mentioned, there is a trade-off between higher income and growing capital over time. But we do aim to balance it in the medium to long term. If we look at our results, we lag the broader market over the past few years. We can do better. When we look at our last year results, this was mostly driven by our portfolio being very defensively positioned in a very strong market. We have a net cash position, and we are underweight major banks, following major option exercises throughout the past year. We decided not to buy back these positions because of the extreme valuations we see in this sector, and as David discussed in detail. Looking at our portfolio in the long term, though, we think we have a really good balance between growth and income, and we think we are very well positioned, firstly, to continue to pay out sustainable enhanced dividend yield. And also we are very well positioned to take advantage of any opportunities that might arise in these volatile markets. On this slide, we provide a couple of examples of our recent purchases, just to give you a flavor for how the strategy works in practice. So on the left side, we have Telstra. We took the view 2 years ago that Telstra was a very different investment proposition than it had been previously. The company had faced a huge disruption from the creation of the NBN and had to undergo a restructuring of their business. And that included a major cut to their dividend, as you can see on the chart on the left side. But by 2023, we felt confident that the worst was behind Telstra. We saw a market-leading mobiles business in a world where people consume more and more data. We saw a very strong management team and a solid balance sheet. And we also thought that there was a higher likelihood that the company can start growing earnings and by extension dividends. At $3.80 to $4, where we did the bulk of our buying in Djerriwarrh, the dividend yield was 5%. And when we gross it up for the franking credits, it was 7.5%, which we think is very attractive. And pleasingly, the company had delivered. It looks like 2023 really was the turning point for the company, as the company continued to grow dividends 6% each year since. Telstra management team is doing a terrific job, and we are very content with our holding in Telstra, as it provides a really good source of fully frank income and growth for our portfolio. Cochlear is another example of companies we have been buying recently. They are the market leader in the manufacture and distribution of implantable hearing products. They operate in large, growing and underpenetrated markets. It's estimated that over 60 million people globally have profound to severe hearing loss and that they would benefit from a cochlear implant. And it's that dynamic that really underpinned the outstanding sales growth record that Cochlear has had in the past 2 decades, as you can see on the chart on the right side. Despite this outstanding track record, the penetration of their addressable market is below 5%. And this, in conjunction with their market leadership position and their continued R&D spend ahead of their peers, really gives us the confidence that they can continue to grow sales for many years to come. Now, Cochlear's dividend yield is 2.1%. It's well below the index, but it does grow strongly, and it provides growth for our portfolio. And we do aim to balance that growth and income in our portfolio. I think that's what really makes Djerriwarrh unique. Our enhanced dividend yield is underpinned by our option strategy. And that really gives us an availability to invest in a variety of high quality companies, not just those who have high yield. On this last slide, we provide a snapshot of Djerriwarrh portfolio as of the end of February. Starting with some key metrics on the left-hand side. We can see that the portfolio value was 850 million, and we held it across 45 companies. Our call option coverage was high at 39%, and our put option coverage was low at 1%. And this all adds up to net tangible assets of $3.29. On the right side, we show the top 20 holdings in the portfolio, and they changed dramatically over the past 12 months. Following major option exercises, CBA, Westpac, and JB Hi-Fi are no longer in our top 20. And companies like Wesfarmers, Macquarie Group, and NAB are still in the top 20, but much lower in the ranking. The proceeds from option exercises and sell down of these companies, some of it we decided to retain on the balance sheet to prepare us for any upcoming opportunities that may arise. And some of it we reinvested to other companies, for example, major miners that had underperformed, like BHP and Rio, really high quality healthcare companies like CSL and Cochlear, Telstra, and even supermarkets, which have really struggled in the past year. And as I mentioned before, we are very defensively positioned. So we had net cash heading into this week, and we also have a very high option coverage, call option coverage in our portfolio. Overall, though, we think that we are really well positioned based on our current portfolio settings to deliver on our investment objectives. So with that, I will pass to Kieran.
Thank you, Olga, and good morning, everyone. So just conscious that some attendees in the room will be Mirrabooka shareholders, but certainly not all. I thought I'd just start with the why again. Why do we run an emerging company portfolio, and why would shareholders choose to invest in Mirrabooka? I think the best way to summarise it is the early identification you get to do when you're buying small emerging companies. That has two benefits. The first being you can discover companies before the broader market does, and therefore capture value in that if you're identifying them well. And then if you do that, you then get the chance to own those businesses for a longer period of time when they're delivering higher earnings growth as smaller companies. There's always a trade-off in markets. So in return for that, when you're trying to identify things earlier, there is more risk on a single stock basis that when you get them wrong, you see false signals and you invest in the wrong company, you can wear greater losses in doing that. Pleasingly, if we look at the performance of Mirrabooka through its history, we think we've got a process that's been working and delivering good returns over our 25-year history in that early identification process. So with these numbers on the chart, we'll see outperformance over all timeframes. A couple of points to note. As with all the performance figures we produce for all our companies, we only include franking credits when we've actually paid them out to shareholders, not when they've been incurred. And in a fund like Mirrabooka, we've had a lot of realised gains that are sitting there as surplus franking credits ready to support future dividends that aren't reflected in the chart. And also just the other point on all these performance numbers is they're rolling periods. So the starting point matters. So if you look at the 10-year number for Mirrabooka, that outperformance is actually sort of at the lower end of what we've been able to produce over our 25-year history. But I was just looking this morning, up to that period, 10 years ago, we had about 8% per annum outperformance in the 3 years leading up to that. So, that just goes to show that you do have this rolling effect when you're looking at these numbers, but pleasingly, performance across all timeframes. Just moving on to how we've been managing Mirrabooka recently, I guess going back to what I was saying about what Mirrabooka is, it's our purest exposure to sort of companies that are growing their earnings. That's what you get when you sort of strip out the top 50 companies and look for these great emerging businesses. We're really conscious of that, and we think in the end, earnings growth drives share prices and returns in the long term. But mindful in a portfolio when you're running it that way, there are points in the cycle to just be quite wary of the risk. When markets are overpricing that sort of company, we've been mindful of this for probably most of the last 2 years, just thinking there's actually a lot of emerging risks around the world. I'm sure there'll be a lot of questions about some of those later on. But equity markets bizarrely seem to be just sailing along and not really pricing much of that. So while we were scratching our head on that, what you can see from this slide, in the 6 months to the end of December last year, our selling was around $77 million, and we only redeployed about $46 million back into the market through that period. And if you look at what's on the slide and we go to the bottom right-hand box, candidly, they're probably some of the best businesses in the portfolio that we're actually reducing. So that's a curiosity. Why would you do that? And really that just goes back to the fact that we have a very high concentration in those sort of companies, and we were just seeing that they were being priced for perfection. So it was a time in the cycle to reduce some of those, realise some gains, build up that franking balance for future dividends, and redeploy it into companies which most of those ones listed on the left-hand side don't have the same sort of growth profile going forward. They're not going to deliver spectacular long-term returns, but they've got really good fundamental asset value underpinning to them. So if volatility in markets arises, these are the sort of companies we expect will hold up better and preserve their value much better than some of the overvalued growth companies in the portfolio. The pleasing part about this is we never know when this is going to play out. You really just got to manage the portfolio as you think at the time. And what we've seen in the last 6 weeks is this volatility has now started. We've seen a number of these companies sell off, and some of the other companies we've been buying on the other side holding their value much better. So we've been pleased. And also we've now got some surplus cash, which we will look to deploy. We don't think we're there yet in terms of the full washout of this volatility and really redeploying it back aggressively into our favourite growth companies. But we're watchful and we're looking for those opportunities to emerge going forward. I won't go through these names in detail. I thought I'd just describe the broad theme, but happy to take questions on any of these companies or any others when we get to the end of the presentation. So my final slide was just on the top 20 holdings in Mirrabooka. We really take a lot of pride in these orange bars. Lots of people say things like they're a long-term investor. It's easy to say that. Even with the activity on the prior slide, we're still only transacting about 20% of the portfolio in any given year. So the core of the portfolio remains quite consistent. And we think the advantage that gives us is we really get to know these businesses, understand their value, understand how they're tracking, which mitigates some of that earlier risk I mentioned, which can be present in this area of the market. I'll just quickly touch on the 4 new additions. There's 4 changes to this top 20 since we presented this time last year. The things that have gone out are companies like realestate.com, Fisher & Paykel and Reece Group, which is firmly in that category of good companies, but we thought were well overpriced. So we've been selling those quite meaningfully. In their place, there's 4 new businesses. One, Vista Group, which has got there by performing really well rather than us buying recently. What Vista do is they're a software company based in New Zealand. Around 50% of the globe's cinema screens powered by Vista software. And they're going through an interesting transition at the moment where they're migrating those customers onto a full cloud offering. So what that means really is rather than just selling software, they take care of the whole IT infrastructure in a virtual sense for those customers. We identified this really well around 2.5 years ago, bought it when it was at its low point in the cycle. It's since doubled, had a really good result in February, and we really think the market's now cottoning on to that really visible growth profile they have going forward. So that's been pleasing for us. The second one I'll mention is Region Group. You'll see we've owned that for 1.5 years. This one's been bought to get into the top 20, not really its performance. What they are is a neighbourhood shopping centre portfolio. You think about your neighbourhood shopping centres that have got a Coles and Woolworths as an anchor tenant, and then all the, the butchers and the various retailers that like to be next door to that. We think this is a really good profile. They've been in a tricky situation where inflation's hurt their earnings, interest rates hurt their earnings, and there's been just a bit of pressure on that, and the valuation's fallen quite a bit. But we think there's a really secure income stream. Those neighbourhood centres have never been as sort of popular as they are now, post-COVID, people working from home. And so they're not over-rented. We think the rents are really fair for their customers. And we think some of that pressure is coming out of their cost base. So we think the income's really secure, and there's a chance for that share price to appreciate over the next 3 years in addition to that. The final 2 I'll mention, I guess a combination of performance and buying have seen those get into our top 20. Cobram Estates, the olive oil company, we think that's a really unique business. They're taking a long-term view with how they're investing in their asset base, both in Australia and the US. And they're very unique in that they have the brand of the olive oil on the shelf right through to the growth of the vineyards themselves, or the olive groves themselves. And so they have expertise right through that value chain. We think that's a really interesting proposition in a food category that's very good for you, has a lot of benefits that we think resonate and will continue to. So we see a lot of strategic value with this asset base they have. And the final one's Worley Group, which has obviously been listed for a long time. It's had a checkered history, candidly, but we think this industry structure has changed a lot. Why we like this company is there's going to be energy transition. Donald Trump's going to interrupt that for a while, but we see that the world needs to get greener over the next 30 years. A lot of companies have got to invest in that, and there's only a few engineering companies in the world that are really well prepared to offer those services on a global scale, which we think Worley are able to do. I'll leave it there, but happy to take any questions on any of these companies when we finish up.
Thanks, Kieran. We'll move on to AMCIL. So I've been the portfolio manager for AMCIL for just over 2 years with the help of Jane Gilbert, who are here as well. So we didn't put the 2-year numbers on there, which is a shame because the 2-year numbers are pretty good. We're a couple of % ahead of the index, but it's just the way the numbers fall. It is what it is. So, and we've also incurred quite a bit of tax over the last few months, which does drag through on the numbers. So if you add back the tax, certainly on the 5 and 10 years and the 2 years, the performance numbers we're very comfortable with. So I thought you might be interested in some of the recent activities. We did hold CBA. And this being a high conviction fund, we exited that completely. And obviously, Dave talked through that before, the reasons behind that. We did have a small position in Mineral Resources. And when the issues came out with the CEO, we got out immediately, which was good selling because the stock's probably fallen another 50% since then. We sort of had grown a bit tired of our conviction in PEX. We still watched that one closely, but we decided to exit that. Domino's as well, we got out of that. PSC Insurance was a takeover, which was great. And PWR, we had a small position on that and we're getting a bit nervous about the outlook. So we got out of that before that stock price had a big fall as well. As Kieran had just been pointing out, it has been a period in markets where has been some valuations that were very stretched. And rather than exiting some stocks completely, like Commonwealth Bank, Sometimes we just take the view of reducing some of our holding if we think the valuation is extreme, and we certainly think we've seen that in Wesfarmers. We substantially reduced our Westpac and NAB positions. Goodman Group, we took a fair bit off at the top. Then Netwealth, Breville, REA and Reece, we reduced those positions, but we still hold on to them because we think they're great companies. And our focus in AMCIL is wanting to be with the best companies, but we will take advantage of overpricing to take some off the top. But we are a bit reluctant to exit fully good companies. And stocks we added to our position in WiseTech, probably in hindsight a little bit early. ARB, we still love their prospects in the US. We think they've got quite a unique position there with the deal they did last year. Block has been up and down. Redox has been up and down, but they're probably close back to our original purchase price. And we've sort of chipped away a little bit at the data centre operator NextDC. And then some of the new stocks, we also put Region into the portfolio. Kieran's touched on that. We added Amcor. They have merged or taken over another large company in the US. And what we've seen in the past is when Amcor have done these transactions, the history says they get a lot of costs out and you get a spurt of earnings growth. And so that's what we're looking for from Amcor. AVT, we've added to it. That's a new stock in the portfolio. We just thought that stock was incredibly undervalued. Sigma we bought into before the run. So Sigma obviously did the merger with Chemist Warehouse and is now trading as that combined business. We think Chemist Warehouse is an unbelievable business. We liken it to, I guess, the early days of Bunnings, JB Hi-Fi. It's got that same look and feel and potential. The stock looks sort of expensive if you look at it off 1 year's profits, but we think the runway of growth is substantial and it should follow the path of those other two great businesses. So that's been a great investment for us. And then we took a small position in a couple of smaller stocks, ReadyTech, Life360 and Cuscal, but I won't go into details on those, but happy to take questions on them. So I guess similar slide to what Kieran did with Mirrabooka, we want to be a long-term investor. We want to always be able to say we are holding good companies. When you have that approach, you will get some volatility in performance. As we saw, we had a period of probably stocks being overpriced. They've come back to fair value, but we do want to stay a long-term investor. But you can see from that slide, there is that mix between some larger cap stocks, CSL, Macquarie, Wesfarmers, BHP, some more, these used to be mid-cap stocks, but they're big now, the Car Group, ARB, Netwealth has been a smaller stock coming through, Macquarie Technology Group, and then you can see down the bottom stocks like Gentrack. So there's a real mix between large, mid and small cap stocks, which has always been the intent of AMCIL. We're happy to have, we're always trying to capture the best long-term growing businesses, but at the same time, if we think we can buy banks at a cheap price, we're happy to have some banks. Or if we see a business like Amcor, which is quite mature, but if we think they're going to have a burst of profit growth, we're happy to have those. Or if we find a cyclical stock that's about to have a burst of earnings, we're happy to have some of those as well. So we have quite distinct categories of what we look for in the portfolio, depending on where we see value and opportunities in the market. So that's AMCIL. We just thought I'd touch on some of the key themes. And I'll just quickly go through this and then we can always circle back through questions. So the majority of companies reported profit results, sort of what we call in line with what the market was looking for. But we thought perhaps the guidance was a bit below what the market was looking for. So, a bit of a sense that perhaps economies are doing it a little bit tougher coming through, and certainly some cost efficiency. So cost out has helped support margins in many cases. But the Australian consumer up to this point has been in reasonable health, and pleasingly balance sheets across many of the stocks that in the market, and certainly the ones that we invest in, are actually in pretty good shape compared to, I guess, some other points in history when too many companies on the market were carrying too much debt. They're in much better shape at the moment. There's still a lot more discussion about AI, how it's being used in business, which sectors are going to impact. The market seems to be going a little bit cold on that at the moment. I guess our general comment was we always thought AI is an important feature of business, but it's just something that businesses have to incorporate in what they do. It's like when computers came along, you just have to introduce it and use it. I'm not sure it generates any real winners as such, although if what the data centre developers are talking about comes true, then they will benefit, because as more and more companies push their computing power into cloud, and there's more AI that requires computing power. So ultimately it should impact data centres, but the market's been wary on those more recently. So if we look at where we've been showing this slide quite regularly, and we have been saying we've been quite cautious on markets, and that's starting to play out. Often we can see here that's the PE of the Australian market and the dividend yield, all showing that more recently the market was fundamentally overvalued. There are different things that can cause a market to pop, and sometimes it's not the reasons you think. In this case, I think it's been what Trump's been doing has caused that everyone to become unsettled and the markets to have a decent fall from their high points. I guess the Trump's issue's been the cause of it, but the real reason the markets are falling is because they're overvalued. So if it wasn't Trump, something else would have come along that would have caused people to get nervous, because when you're fundamentally overvalued, history shows eventually that will reverse. So, and what we're seeing now when we look through the market, I wouldn't say we're finding cheap stocks yet, but I think we're probably saying we're starting to see some good quality stocks that are certainly fairly valued. And that's not a bad point to start saying, actually, we'll nibble at some of those. But with the market at these levels, we're not sort of piling in yet and saying, actually, these things are really cheap. So I think importantly, when you get into these times, stocks can be volatile. But as I said, if we think the world is getting into a tougher place, you need to, more than ever, be able to look through your portfolio and say, we are holding good companies. They're in strong financial position. They've got the ability and the capability to try and grow their profits regardless of what's going on. And I think that's what will get through what potentially could be some more challenging times ahead, but we just don't know. And these are the valuation metrics on the US market, looking at the PE on the left and the dividend on the right. So all pointing. Now, there's reasons why you might say, look, things are different now, and I think there's always merit in that. In the US market, there are a lot more tech stocks. They produce very high return on capital. The US market has had much stronger profit growth than our market. So there are reasons why perhaps the PE should be higher, but we always get wary when we see charts like that. Just a comment on, I guess, going back to a bit more about the structure of our 4 listed investment companies. So we are companies listed on the stock market, and as such, what we call a closed-end structure. So if you put money into any sort of managed fund or an ETF, they're constantly every day having money flowing in, flowing out. So when money flows in, they've got to buy stocks. When the money flows out, they've got to sell stocks. Because we've got a fixed structure, we don't have money flowing in and out. And so we control when we sell and we control when we buy. And we think that really lends itself to good long-term investing. We see more recently, and I think banks are probably a feature of that, because we were scratching our head trying to understand why the banks were so strong. And the only thing we could really land on was that index and ETF and industry funds, when they had money coming, they just have to buy. And whereas we look at it and go, we don't have to buy. we'll buy when we think there's value. So, and that goes to the point again about, we're not forced to buy in overheated markets, or nor are we forced to sell when markets go down. And the other thing about the structure of our companies, and I touched on this earlier, when we make capital gains, they generate a franking credit, but they tend to go in our reserves. Now, our funds at various times pay out some of that, but we always like to keep a little bit up our sleeve. So you saw during COVID, we were able to sustain our dividends, and that's when we draw our own reserves. And for those that have been with us for a longer period of time, they'll remember the GFC, the same thing happened. And we understand that our shareholders really appreciate us in tough times to be able to say we continued the dividend through the tough times. I think probably the final element that I've just talked about, given we are in markets, we do participate in, if companies are doing deeply discounted placements or buybacks or other corporate actions, we obviously are right in amongst that in the market. And if they see opportunities, we can take advantage of those. This is my last slide, but I think it's a really important one. There have been, and most shareholders will be aware of this. So we're going through this bit of a strange time we're now putting out a weekly NTA. So that is essentially the fair value of the company. And that comes out every Monday morning alongside our normal monthly NTA, which we put out. And so that's telling you what the fair value of the business is or the portfolio is. And then when you look at the share price, at the moment, 3 of our funds are actually trading at a discount and have been doing that really over the last year or so. So if you look at the top left, that's the history of AFIC going back how many years? Over 10 years. And it just shows you it's actually spent more time trading at fair value at a premium. We're at this strange situation where we're trading at a bit of a discount at the moment. So I've never really seen discounts like that before in AFIC, and I've been involved for over 30 years. Djerriwarrh is at a slight discount. Mirrabooka is probably trading at around fair value, and AMCIL would try at quite a steep discount. And so there are many reasons. We get lots of questions. Why are they trading at this discount? And the only thing we can conclude is that there are perhaps a number of factors that at any one of those important at a point in time has caused us to trade at a bit of a discount. So, for example, when markets are hot, we tend to trade at a bit of a discount, and we've been through a period of a hot market, and so that can weigh on it. There have been, over the last probably decade, there have been many new LICs come to the market. Now, we need to start to differentiate ourselves, because we would say we're a traditional LIC because there's no external fund manager, there's no performance fees, whereas many of the new LICs have an external manager, charge high fees, high performance fees, and have performed really poorly. And so I think that's created this bit of a sense around LICs. Are they good? Are they not? But we're a traditional LIC. We're not like the others, but I think that's also weighed on the stock prices. And I think the other thing too is that, we basically had 10 years where if you wanted yield, you couldn't get it from the bank. And so there were a lot of investors, and particularly retirees, who were buying shares to get yield. With interest rates now going back up, you can now go in term deposits, fixed interest, and actually get a reasonable yield. And I think that's probably taking a bit of buying out of the market for our sort of products. But all I can say is that, when we're getting down to sort of a 10% discount, you can buy dollars worth of assets for 90 cents. You can see the stocks, you can see the quality of the companies. It actually means you get a high yield if you can buy it at a discount. So I think ultimately this will correct itself at some point in time, but there's certainly these charts are saying there's value there at the moment. Particularly, I was having a discussion with someone this morning, with the market having fallen, you can now buy the market at a lower level again by the discounts we're seeing on these LICs. So that's my bit of a pitch. And as I said, we are all substantial investors in four LICs, and it's in our interest to see them perform well over the long term. So with that, I think it's time for questions. I think Jeff will moderate these.
So I'll moderate the questions, and I have reserved the right to ask my own questions just to keep the team moving. But we have a couple of microphones, so put your hand up and we'll go from there. And just say who you're addressing it to as well, please. Thank you.
Well, my name's Greg Elson. I'm just addressing it generally, but last financial year, directors' salaries and packages went up approximately 15% on average. During that time, we saw quite a lot of appalling behaviour with things like tax evasion, bullying, sexual harassment, all sorts of things like that claimed against various directors. What I would like to know is, during the voting that goes on, how many remuneration reports has AFIC knocked back? How many directors' appointments have they knocked back? And how many packages for directors have they knocked back? And what I'd also like to mention is that little book that you put out, I think that would be good if that was actually shown in there, because then we know that you're actually looking after us.
Okay, thank you.
Voting is a very important part of our process, and it goes to our formal investment committee. And so they get a recommendation from the investment team. And it's an important part of being a shareholder is having your say. Now, I don't have the numbers offhand. It's perhaps I can take that on notice about that. But, generally, it's fair to say most of our votes are supportive, because we hold, across the group, we're probably holding over 100 companies. But if we see something we don't like, we will vote against it. Certainly there have been occasions over this year we've voted against REM, just trying to think of directors. If we see a director we don't like, we'll vote against. But the important part of our process is not just to vote, is to have an interaction with the company as to why and what we're looking to change. Sometimes in the past we've been concerned, so we might abstain and send a clear message. If we see something we don't like, we'll vote against. But we take it very seriously, because having a company that's well run will lead to better performance for shareholders over the long term. We passionately believe in that. And so there have been situations where we didn't see what we liked and we just got out. But then there are other situations where we have to sort of perhaps take a bit more time in terms of, can we influence outcomes? Because obviously at the end of the day, if a company's got great assets, we own the assets, we're the owner. We don't want to give up good assets and good businesses lightly. So if we think there's something wrong, we'd rather see the company improve, or if there's something wrong with the people, we'd rather see the people change than us jump out of it. And I guess the other thing that we know, even more recently we were talking about, is that you can't affect change if you're not a shareholder. And if we like the assets, that would be always my starting comment. We want to stay an owner of great assets. And can we make change if we see something we don't like? If we try and we just can't, then that becomes a discussion about what we do next.
Thanks, Mark. Another question over here.
John Spragg. One question: what sort of market conditions prevail that would encourage you to either increase or reduce gearing? Very general question.
Yeah, I'll just make a start. I mean, it's probably more about the market level, because as I said, there's a lot that goes on and gets talked about in markets, but you always have to go back and say, where's market? So when you have gearing, you're borrowing to get exposure to the asset price of the day. And so the number one rule of gearing is not, do you think you can accommodate debt? Can you pay for debt? It's, are you buying something that's fundamentally cheap? Because if you bring in gearing when prices are high, you're actually going to have the opposite of impact of what you want. And so Djerriwarrh is the one that has gearing. If you look through the history of AFIC, AMCIL and Mirrabooka, I mean, really we don't have gearing. We've got a little bit of cash most of the time. Occasionally we might borrow a tiny bit, but really you could see those as effectively pretty close to no gearing. So what the team have been doing is really having a bit more of a fundamental view of where the market is. And so, as Olga pointed out, if you go back even just a few months, we probably had the most cash I think I can never remember us having. And as the market's fallen, so if you look at where we are today, we're pretty much now fully invested. And if we see another pullback in markets, we would start to get back to our more traditional levels of gearing if we saw better pricing on stocks. So it's the fundamental pricing of the asset that really determines how much gearing you should have.
Yeah, but as you said, Mark, Djerriwarrh is really the only one who uses gearing to any great effect. So
thank you, Max Carr. Probably a question to Mark. Where are you at in your investigation into a future LIC in international portfolio?
Yep. So I was hoping someone would ask that question, because if you didn't, then Jeff, it's on Jeff's list of things to ask about. Look, we still, so for those that don't know, we've got about 1.5% of AFIC's portfolio in our little international portfolio. And that in itself has about 45 stocks. And if you've got more questions on it, we've got Andrew Sutherland. Andrew, you can stand up and wave. And so Andrew's one of the team members involved. He's one of the portfolio managers and running that. And so what we've been doing is running that. And what we've been exploring is, can we spin it out as another LIC? Because the idea of that would be compared to other products in the market, relatively low cost, no performance fees. If you make scale, the shareholders get benefit for all that. So we think it's something that would be of interest, but we've got to have the right conditions. So, we're very patient with these sort of things. So we want to continue to build up a track record. It doesn't help that LICs at the moment are trading at a bit of a discount, but we think that could change. Currency, the Aussie dollar has been quite weak. So that makes it a bit more challenging to say, shareholders, you should put money into international. So we just need to get an environment where those things come together, and it's possible we could come to the market with a new LIC. But in the short term, that portfolio has added real value to the AFIC performance. It's performed well, and we're really happy with the team and the investment approach. And so we're comfortable with it continuing to be a small part of AFIC. I'd probably like it to actually be a little bit bigger, because when you look at the stocks in there, they're great companies, fantastic companies. So if anything, probably next step at some point, try and make it bigger and then look to see if we can get an LIC. But even if it sits there like this for another 6 months, year, whatever, I think it can still add value to the AFIC performance overall.
Mike Rawlinson, could you tell us about riding the Trump roller coaster?
Look, I'm going to pass it to the team initially, because I'm not going to have a great deal of insight here, because it's just so unpredictable. And I don't think you want to be basing any great investment strategies around it, because it's going to change tomorrow. It'll be different tomorrow and it'll be different the next day. But it just makes me uncomfortable about broader economic activity, and particularly where the market was sitting and perhaps where it goes from here. So who's going to go first? Kieran?
Kieran, okay.
To be honest, for what we do, I think we're in a bit of a fortunate position that if we own great companies, they have to adapt their business to whatever settings are put in place. So if there's tariffs, if there's dramatic changes, they've got to strategize on how they can keep winning as a business. Our job is to actually make sure we've got a portfolio full of people with good assets, good competitive position, and good people that can adapt. And so I go back to, I guess, COVID. I mean, this is uncertain, but it's nothing like trying to predict when a vaccine was going to work and when we're all going to return back to normal life. And, you know, the amount of predictions that happened then about this is going to happen next, that's going to happen next, no one was right. So I just think this is another wild card sort of period like that. We can give you all our theories. They won't be any more valuable than yours. But if we've got a portfolio full of really good companies, of people that every day are desperately trying to make their business work in the settings they have, that's the comfort we can take. And at least now there's some uncertainty being reflected in share prices. So I think the greater risk was last year when we're all sailing along with these crazy valuations, to be frank. And, you know, a wildcard event like this is going to knock share prices around. So if we get into a period where some of this risk is being priced and our great companies are strategizing on how to adapt, then I think we'll find some opportunities out of it.
Dave, do you want to follow it up? Or yeah,
I was just going to use one example. So Fisher & Paykel Healthcare is a company that we own. And to Kieran's point, there's two parts to this. It's what happens to the earnings as a result of all the tariffs versus what happens to the share price. And we can have a view about the impact on earnings. And when we see the share price get to really attractive value, we want to be buying more of what we think is a really good company long term. So Fisher & Paykel do respiratory therapy, so they provide oxygen to people in the hospital setting, and they provide humidified air which keeps the oxygen levels higher and allows a patient to recover more naturally than being on a ventilator. And they manufacture 40% of their products in Mexico. So if the tariffs do come on Mexico, that's a tax effectively on Fisher & Paykel. But the balance of the manufacturing is in New Zealand. And so they have the capacity to switch that to New Zealand. Yes, there'll be more freight, but they're the market leader in what they do. They can put a price rise through to their customers, or ultimately they'll move the manufacturing to a place where they can actually have spare capacity. So either way, it's a business that has that flexibility to be able to navigate through this. And the share price has fallen pretty materially. And if we expect that to continue, we'd be looking to add to that as the fundamentals still stack up really strongly for a fantastic opportunity.
Just perhaps I would just add another example to that. In the energy space, Trump policy, energy policy was one of the pillars of his campaign, not his presidential term. So it really weighed on the stock and sentiment about the oil prices. So his goal is to decrease oil prices, and he has several tools. So he wants to increase domestic production, and he also wants to deregulate the industry to incentivize higher domestic production, as well as some geopolitical maneuvering, especially in Russia and in the Middle East, in Iran. So when we think about the actual impact on oil prices, it's very hard to know how it will play out. It definitely is impacting the impact. The one thing we would say is that increasing domestic production in the US in a very short term is quite difficult. And there's a few reasons for that. You need to get your projects permitted. You need to construct them. And LNG projects take a few years. And also, I think that the strategies of the US oil and gas companies have changed dramatically over the past 5 years. So they really are prioritizing now shareholder returns over production growth. So it will be interesting to see how it plays out. When we think about our exposure in energy, and that's Santos and Woodside, we think that they continue to really give us a unique exposure to LNG. And our view on LNG has not changed. We continue to think that LNG will be the key transition fuel that will help the world transition from coal to renewables and other net zero fuels and energy sources. So we think that we are very content with our exposure there, despite the short-term volatility we see.
So I just had one final comment back. That's probably something Kieran touched on. So if this causes ongoing substantial weakness in the market, whether it's created by Trump or anything else, doesn't change the fundamental view is if that causes the stock price to go lower and lower, we'll become more and more interested in buying more and more good companies. And we've seen that throughout history, and we said the same thing during COVID. The peak of the frenzy, I remember we did these meetings and we said, we don't know what's going to happen, but history says whenever you get a substantial sell-off, doesn't matter what the cause are, if history repeats itself, the best thing you can do is buy. And so that's sort of what we're starting. We're not buying substantially yet, but we get a bit more excited we often, I know it's a bit weird, but we often get excited when markets have big sell-offs because it gives us a chance to buy the best quality companies at good prices. And that's ultimately what you want.
Thanks, Mark. Any other questions from the floor?
Andrew Walpole, been a long-time shareholder. 2 questions. First is that currently you are operating buybacks in the market, and how much of a discount does there have to be before you buy back? And the second question is this company I've been watching in Adelaide for quite some time, MX1, who use carbon nanotubes for making X-ray equipment, which is much lighter. Do you have any research or any interest in?
I'll take the first question and then pass to Kieran for the second one because I'm sure that Kieran's all over that one. So the buybacks, we haven't done really a lot of buyback over my time. I remember we did it once 20 years ago, I think, when we had a bit of an opportunity. But we've always had a buyback in place with the stock exchange because you have to have it in place if you want to do it at some point. But as we saw on the slide, this is very unusual for us to see such large discounts. So we constantly talk about it. We talk about it with the boards. I think a rule of thumb is something around 10%, but prices, move around a fair bit. I guess the other consideration, which perhaps might say, well, maybe 7% we might be comfortable with, is particularly when we've just had a DRP. And so we've issued stock, and obviously we've had an approach that we just leave the DRP in place. We don't turn it off and on because we find that it's generally the same shareholders to an extent who are either in it or not. And so we've had periods when we're at a premium. And so people are in the DRP are paying a bit too much. So at the moment now they're getting a bit cheap. But if you're issuing stock at a discount, it's actually a good opportunity to actually buy it back and neutralise. Otherwise it becomes quite diluting. So certainly to neutralise the DRP, maybe it's 7%, something like that, or where we've got an eye to what the DRP price was, and if we can pay around that, if it's lower, that's better. Neutralise that, and once we've done that, we're probably back to more something like 10% discount. But again, we might narrow that if we had a dramatic market sell-off and we were trading at another 5 or 6%. That might be a reasonable number for us in a low market. But we think it's a good strategy for where we are at the moment because we look through and say, well, if we've got a bit of cash, what's the best thing we can buy? And in my case, looking at AMCIL, I just go, well, I can buy all of these stocks. If I look at the price where they are now, I can actually take 10% off all those. That looks pretty good buying to me. So, one of the best things we can do with our cash when you're a large discount is just buy your own stock back.
I suppose the other point, Mark, is we don't try and soak up all the liquidity in the market. We do a lot of buyers and sellers in there as well. So it's about that balance also. Kieran, you want to answer that question?
Yeah, so look, in emerging companies, we pride ourselves on casting a pretty wide net and making sure that we're aware of anything that's out there that we should be looking at. We obviously define what we're looking at more closely, to make sure we're not wasting time on things we shouldn't be. But I've got to say, I've been doing these meetings more than 15 years, and I think you've just come up with a prize because I don't think I've ever had one that's stumped me. I've never heard of them. So maybe you should get the first cup of tea or something as a prize because normally when someone asks a question about a company, we'll have at least heard of them, read some research or seen them, but you've piqued my interest. So we'll do a bit of work when we get back to the office, and if you come to the next meeting, we'll have a better answer.
So, Kieran, I think your colleague actually knows about it, but that's okay.
Maybe that's the answer. Stu's been doing the work. I haven't. Do you want to get up, Stu? I should have checked there first. That was my mistake.
Because MicroX is the nanotechnology. We actually met the company about 18 months ago. As you mentioned, a different way of X-raying. They also, you know, probably better than I do, but interesting use case inside airports as well for scanning people, bodies and other things, and also some technology around bomb detection too, which was quite interesting. As Kieran mentioned, it was a very small company. We cast the net quite wide, and I think they'd just gone through a management change at the time. So that was a bit of a reason for us just to wait, put on the watch list. And from my recollection, the balance sheet was a little bit tight, which I think probably in the last couple of months they raised some money. So interesting to us, but the combination of management change and a sort of a tough balance sheet meant it was sort of just a watch list stock for us at the time. But good point for us to probably re-engage, I guess. It's been a little bit more time on it.
So that's quite embarrassing because I was in that meeting. So there you go. It goes to show that I'm obviously getting old, and that's where the real credit goes.
There's no secrets at this meeting, Kieran, that's for sure.
So that was Stuart Lowe, everyone.
Yeah, helps Kieran out. Any other questions from the floor? I'm going to use a bit more inside information. My apologies up front, Dave. So you've added BlueScope to the portfolio. What was the thinking behind that over more recent times?
Yeah, thank you. I added BlueScope late last year. The share price had been under pressure. There'd been falling steel margins, particularly in the Australian market. So just to recap, so they're a steel producer in the Australian market and also in North America. Got some small exposure in Asia. The two largest parts of the business are here and in the US, and you'd know their product within the Australian market is ColourBond, and they've been able to take significant market share in terms of roofs on new housing construction. That's been a pretty consistent theme over 10 or 15 years. So late last year, the share price had fallen quite materially. There'd been pressure on steel spreads as China had been exporting a lot more steel, and the share price had fallen to a level that was below asset backing, and history shows that anything below asset backing for this company has been an attractive entry point. And then we caught up with the company a number of times and just said to understand and see what the strategy was in terms of things they can control. So they do have a cost out program which is quite material in terms of their earnings base, and they're investing quite a lot of money into ColourBond itself, but also into the US market where they've got a strong asset position. Their customers are close to their facilities, and they've got off-take agreements, meaning everything they produce is sold to their customers within close proximity to where they produce it. So you're still at the whim of steel prices moving around, but in terms of what they produce and their ability to sell it, they're in a really strong position. The management team have done an excellent job. They've been there for an extended period of time now. We really support what they're doing. And most importantly, in a cyclical industry, they've been able to maintain a net cash balance sheet. So that means they've got no debt, and they're generating significant free cash flow, which is funding the investments into those programs, making the business quality better over time. So really attractive entry point for us, and it's been performing well in recent times. And this is kind of wasn't part of our investment thesis, but part of the steak knives, I suppose, was just the tariffs that are being put on by Trump, if they do in fact get enacted, will be positive for BlueScope. So BlueScope export about 300,000 tonnes of steel from Australia into the US market. That will be a negative with what's been announced earlier this week. But offsetting that is they produce 3 million tonnes of steel in the US market. And when the Trump tariffs went on in Trump version 1, we saw steel prices respond quite positively, and that all flows through to cash flow that this business is able to generate. So it wasn't part of the core investment thesis, but it's been a free kick that we feel we haven't had to pay for.
Olga, you and I were talking the other day about the reporting season, or sort of what sort of occurred through the reporting season. Do you want to talk about the stock price movements, what you actually saw through that period?
Absolutely. So this reporting season was quite unusual. So we had a lot of results that came in line with the beats and misses to consensus, mostly balanced. But we saw really unprecedented volatility in the share price. So we saw a lot of double-digit share price moves, and we also saw a lot of intraday swings in share prices, with companies opening positive and going into negative territory and vice versa. JB Hi-Fi was a good example. They had a really good result and they opened up at 5% up, but they closed down 5%. So it's really difficult to pinpoint what drove that volatility in this particular reporting season, which we think is probably the most volatile reporting season in the last 20 years, even more volatile than what we saw during the GFC or during COVID. But we think that the starting point of really high valuations really contributed. And then some of the market forces we are seeing, so increased passive investing in the markets and also low liquidity. So how we think about that, those sort of lot of noise that we see in the market really creates a lot of opportunities for active managers like ourselves. So we will look when the share price is really not aligned with fundamentals we see in the business, and we will act on that accordingly.
Thanks, Olga. Any other questions? Yes, questions at the back here, sir. Thanks.
Paul from Bendigo. If you had a top 20 company in your, this is open to anybody, if you had a top 20 company that all of a sudden the price fell 20% and you thought it was a good time to buy, how long would it take you to action the buy thing? Do you have to meet and discuss and it'll take a week or a fortnight, by which time the price could have gone up? What's the sort of process on that?
I might start with that. It's probably more realistic in my end of the market, to be honest, because not many AFIC top 20 stocks fall 20% very suddenly. We can act straight away. So we have investment committees that are there to sort of oversee what we're doing, and we report into them, but we're never waiting for an investment committee. We have approval limits in terms of size of investment. You know, you refer through to let the CEO and chairman know if it's over a certain size to manage risk, as you'd expect. But there's never we better discuss this as a broader team in a week, and, you know, we could be quite nimble on that. And what I'd say is particularly so with things that we already own. So most of what's in our top 20 we'll have owned for a very long time by the time it gets there, and therefore, you know, we think we understand the risks well, and that's the situation. We typically, if they fell that much, we'd be a buyer, all else being equal. If it's a new stock, that's where, you know, we'll be a bit more thoughtful. There's no constraints on how, you know, again, we don't have to meet and have long conversations about it, but you do tend to just think about the shiny new toy a bit more than the thing that you know well.
Yeah, so I just add to that. So that's important, really important part of what the team do is just ongoing meeting with companies that not just we invest in, but you need to be following stocks that could be of interest that we don't invest in, because when those situations arise, you want to be able to act as quick as possible. And so that's one of our key jobs. So we usually meet with the management twice a year, more formally, but then the team will go to probably one or two conferences, investment conferences throughout the year. And then many companies will do side visits or strategy days, which we'll go to. So it's really about just consistently staying in touch with the company does, what they do, so you can have that conviction when you see an opportunity. You know, one of our key roles is to grab opportunities when you see them. And so it's important that we sustain an understanding of a broad pool of companies, not just the ones we own on an ongoing basis.
Thanks, Mark. We might make this the last question given we've been going for an hour and a half. So
thanks. Yeah, Don Phillips. The reason I invest in an LIC is because I admit that I can't identify the next high growth stock. So I want you guys to do it for me. So two companies in recent years in Australia, Fortescue Metals and Pro Medicus, have had spectacular growth. And I think I'm right in saying you don't have any exposure to them. So my question is, how did you miss those?
Well, I'll start. So I can remember all the discussions around Fortescue at the time. Look, and all credit to them, that they've just done a spectacular job. But at the time, the CEO had a bit of a checkered history. We certainly had a lot of a bias towards the companies that were producing cash flow, were at the bottom of the cost curve, produced the best products. So even to this day, BHP and Rio have a better quality product, better position on the cost curve. And there was always a view that when things get tough, lower quality iron ore is what gets hit, and we want to be with the best assets. And that was our position. But I think what we probably misjudged with that one was how well they did it building out low-cost infrastructure. I guess probably where we got it wrong is we were probably too much hearing BHP and Rio, and BHP and Rio building out a new mine would cost this much. Rio came in and built it for this much, very lean. And obviously then it was a period where the iron ore prices continued to trend up. And so we missed that piece for those reasons. But it's probably not on our watch list now because we just think things have changed a bit. We're more cautious on China peaking out. We're cautious about iron ore coming in from Africa soon. That's probably going to start at the end of this year, which is very high quality iron ore. China very much back that, so we think they'll take that above anything else. So we did miss that one, and Pro Medicus, we got that wrong. We'd met with the company, we saw it fitted our frameworks, and probably we just didn't act. And that's probably the lesson out of us, because we got to constantly take lessons out of this.
we don't get them all right. But that one we should have just taken a position because it did stack up really well. So it shows you got to be early to a story, and if something lines up, make sure you get a position, which is really the learning out of that, because it is a terrific company.
Yeah, the only thing I'd add to Pro Medicus, Mark's exactly right. That's been a really bad miss, really, because it's a fantastic story. We owned it in the really early days before they bought the US asset that's unlocked the business, which makes it even worse. And they weren't going very well for a while there, but then they bought this product, Visage, which is just a more efficient way to transmit images in radiology, and it's completely changed the market over there. And the reflection on that is once that started to work, the stock looked really, really expensive on near-term earnings. But in a market the size of the US, if it's on 1% market share going to 10, you shouldn't even really look at the valuation metrics. If you form that conviction that they're winning and there's a massive market ahead, you just buy it. You have to own it. So we like to think we've learned that lesson, and that's a hard way to learn it because you see it go up every day for as long as it has, and you think about what could have been. You can't go back in history back to when we should have made that assessment in Pro Medicus, but we like to think we've refined our thinking so the next one that comes along, we won't be standing at the bus stop watching the bus leave.
And you have managed to pick a few winners along the way too, Kieran.
That's right. But no, you got to keep learning from that.
That's right. Yeah. Okay, we might wrap it up there. We've been going for an hour and a half now. So thank you again for participating this morning. If you've got any feedback about this meeting and having the four companies together, please let us know. But we've got some morning tea or light lunch happening now. And the team's available for questions. They'll be around for a while. So please talk to them as well. Thank you.